Welcome to The Explainer. Today we are completely demystifying option pricing. We're going to take a journey from discrete binomial trees all the way to the legendary Black-Scholes model. I am so thrilled you're here with us because honestly, we're going to unpack one of the most fascinating and, yeah, occasionally intimidating, but absolutely essential areas of finance. If you've ever looked at the markets and just wondered how on earth analysts put a precise, exact dollar figure on something that is entirely uncertain, well, you are definitely in the right place. We're going to learn the absolute basics of option pricing so you can understand exactly how this works under the hood. So let's just jump right in.
Okay, so here is the fundamental question that pretty much hooks every ambitious investor. How do you value an asset that makes absolutely zero money today but literally might make billions tomorrow? Think about it. Imagine a pharmaceutical company holding a totally unproven drug patent, or an energy firm just sitting on a massive undeveloped oil reserve. I mean, if the FDA approves that drug, or if global oil prices suddenly spike, boom! Those assets are instantly worth an absolute fortune. It's essentially a multi-billion-dollar lottery ticket. But if the drug fails or oil prices tank, they might be completely worthless. So how do you attach a reliable, concrete price tag to that level of pure potential today?
Well, for decades, the absolute gold standard in finance has been discounted cash flow, or DCF valuation. And look, DCF is fantastic, right? It tells us that the value of an asset is just the present value of its expected future cash flows. Makes sense. But DCF actually has a massive blind spot. It totally struggles with assets that don't generate steady cash flows right now, or where the cash flows only happen if a very specific event occurs. Like, if you try to use a traditional DCF to value that undeveloped oil reserve, you're going to consistently understate its value. Why? Because DCF completely misses the flexibility the company has to just wait, to see what happens to prices and only develop the reserve if it actually becomes profitable. So to fix this blind spot, we need a totally different approach.
And that is exactly where contingent claim valuation comes in. A contingent claim, which is just a fancy word for an option, is an asset that pays off only under certain contingencies. Basically, it pays off if the value of an underlying asset crosses a pre-specified threshold. This framework is a real game changer because it accepts that the value of an asset can actually be greater than the present value of its expected cash flows, all because of the hidden value of that contingency. This is the exact framework that allows us to finally put a price tag on all those crazy what-ifs. Think about the net payoff on a standard call option. Your maximum loss is totally capped. It just stays completely flat, representing nothing more than the upfront cost of the option, until the underlying asset crosses that magic threshold, the strike price. But once it crosses that strike price and hits the break-even point, the payoff potential slopes upward infinitely. There is no ceiling. The value of this asset is entirely derived from its underlying asset passing that specific finish line. But how do we actually figure out what to pay for that infinite upward potential today?
The answer lies in what I consider the greatest aha moment in the entire history of finance. It's called the replicating portfolio. The elegant logic here is all based on arbitrage. The idea is simple. If you can create a portfolio using a mix of the underlying asset, like, say, buying shares of a stock, and some risk-free borrowing, and this portfolio mimics the exact cash flows of the option in every possible scenario, well then, the option and your built portfolio must cost the exact same amount today, right? If they produce the exact same cash flows, they have to have the exact same price. We use this secret key to literally unlock the price of the option.
This specific concept builds perfectly into our first pricing framework, the binomial model. This model relies on a beautifully simple assumption about how asset prices move. You start at the current price today. Now, in any given time period, that price can only do one of two things. It can move up with a certain probability, or it can move down. That's it. Up or down. It's discrete. It's predictable. And from those new points, it jumps again, up or down. Over time, it forms this branching tree of possible future prices.
Okay, so how do we actually use this tree to find our option value? We follow a highly logical three-step process. Step 1. We don't start at the beginning. Actually, scratch that. We start at the very end of the tree, at the expiration date where we know exactly what the option is worth based on the final stock price. Step 2. At those final endpoints, we build our replicating portfolio of stock and borrowed money. And step 3. Reverse engineering time. We work our way backward iteratively, node by node, step by step, until we arrive all the way back to present day.
Let's put some numbers to this to make it real and see the math in action. Imagine we are trying to replicate a call option with a strike price of $50. If the stock goes up to $150, the call is worth $100. If it drops to $50, the call is worth $0. To replicate this perfectly, we just solve for two variables,
delta, which is how many shares to buy, and B, which is how many dollars to borrow. The math works out perfectly so that if we buy exactly one share and borrow $45 at an 11% interest rate, our portfolio is going to yield the exact same $100 or $0 payoff as the option. Because those payoffs are identical, the value of the call option today has to be the cost of buying that one share minus the $45 we borrowed. Boom, solved.
Now, the binomial model is highly intuitive, but it does require calculating prices at every single node, which gets tedious. So, what happens if we want to be more precise? What if instead of big, clunky jumps every quarter or every month, we make the time period shorter and shorter? As the time intervals in our binomial tree become infinitesimally small, literally approaching zero, the price changes become this smooth, continuous process rather than discrete, blocky jumps. And when that happens, the binomial model miraculously morphs into something much, much more famous, the Black-Scholes model.
Behold, the Black-Scholes formula. Published back in 1972 by Fisher Black and Myron Scholes, this one equation completely revolutionized modern finance. Now, I know what you're thinking. You're looking at all those natural logarithms, standard deviations, cumulative normal distributions. It looks deeply intimidating for sure. It looks a bit like alien alphabet soup. But please, don't let the Greek letters scare you off. The foundational logic is exactly the same as the replicating portfolio we just built in the binomial tree. We are still just combining the underlying asset and a risk-free asset to mirror the option's cash flows. And the absolute best part? This entire terrifyingly complex formula really just boils down to 5 variables.
That's right, just 5 straightforward inputs determine the entire value of this European call option. First, you've got the current value of the underlying asset. Second, the strike price of the option. Third, the time left until the option expires. Fourth, the riskless interest rate. And fifth, variance, which is just the volatility of the underlying asset. If you have those 5 numbers, you just plug them into Black-Scholes and you get your completely objective valuation. It really is that elegant once you get the hang of it.
So here is the real kicker. Of those 5 variables, 4 of them are basically readily observable facts. The current price, the strike price, the time to expiration, and the interest rate, those are knowns. The only input where investors can really have a massive disagreement is the variance, or the volatility. Sometimes, analysts will look at the actual market price of an option being traded and they'll run the Black-Scholes formula in reverse. They basically ask, what variance rate makes the model's estimate perfectly equal the current market price? This magic number is called the implied volatility. It's essentially the market's collective vibe check on how wild the asset's price swings are going to be in the future.
Now you might be wondering, why does this all matter for us? Well, these models aren't just for Wall Street traders day trading stock options. They are used to value real, physical, everyday assets, often called real options. Think back to our earlier examples. A drug patent? That's a real option. It gives the firm the right, but not the obligation, to commercialize a drug if it proves viable. Undeveloped mining reserves are just options to extract stuff if commodity prices rise. Heck, even investing in a weird little off-Broadway show is an option. The expected cash flows might look absolutely terrible on a standard DCF model, but there's a tiny, non-zero chance it becomes a global Broadway blockbuster. Contingent claim valuation allows us to capture that immense upside potential accurately.
Which brings us to our final thought. Now that you understand the mechanics of learning the basics of option pricing, like the replicating portfolio, the binomial tree, and the Black-Scholes model, I want you to apply this new lens of contingent valuation to your own investments and business decisions. Where are the unpriced contingencies in your life? Are you maybe relying on rigid DCF models that actually punish flexibility? What hidden, real options, whether they are side projects, flexible business strategies, or undeveloped intellectual property, are you completely undervaluing in your own portfolio right now? Keep learning, keep analyzing, and I will see you in the next explainer.